Welcome back to Making Money Matter, ladies and gentlemen. I've got a final Christmas present of the year for you, and it should be pretty much the final one because it's Christmas next week. My goodness me. Rick Rule, investor and speculator, my good friend who also runs the Rule Investment Media Conference. You know that I go to it every year. It's going to be in July back in Boca Raton. So want as many of my beautiful audience out there to come over because there are people there that you will meet that you won't meet at any other conference. And it's bloody good conference. But Rick, welcome back to Making Money Matter. We're actually going to do a deep dive into gold today because of many reasons, but one of them is I'm very, I guess, passionate about educating people on why gold right now is going to be very important to you and especially going forward. So let's do a deep dive into gold. But first of all, welcome back. Lovely to see you.
Lovely to see you, and thank you for having me back to discuss a topic that, as you know, I'm also passionate about. Thank you, too, for your participation in the Natural Resources Investment Symposium in Boca Raton. The attendee evaluation forms mentioned your cheerful personality and your glittery dresses more than once. So thank you for adding luster and color to my conference.
Well, I'll bring back the gold jacket. But
Great.
look, one of the things that you are going to be doing, and ladies and gentlemen, we've got Gold Coast Gold happening in Surfers Paradise on the Gold Coast on the 13th and 14th of March next year. But here's something the reason I brought Rick on, he's doing a virtual event on the 11th of January, 2025, from 8 a.m. to 4 p.m. Pacific Daylight Time. Now, for those of you here that are already sitting up going, oh my God, that's 3 a.m. here, don't worry about it because you're going to get full access. Like if the time frame doesn't work for you, register and then you're going to get full access to the event post the event. And the reason that I want you to do it is I want you to be well educated before you come to Gold Coast Gold. So before we dive into inflation and gold and all the different things around that, why did you decide to do this virtual event, Rick?
Well, as you know, Carrie, every 90 days we do a deep dive into something,
Right. Okay.
some aspect of natural resource investing. And I should say at the beginning, the boot camps aren't for tourists, Carrie. Uh,
They're
they're
going to
not
work.
entertainment events. They're a lot of work.
Yeah.
We take 8 hours out of a person's life and we cram more information into that 8 hours than they can consume. So we ask them, I can't tell you what to do with your time or your money, but we ask you, in order to get the most out of the boot camp, that you replay the recordings at least twice,
Hmm.
which is to say, I'm not going to take 8 hours out of your life. I'm going to take 24 hours out of your life, and I'm going to charge you for it.
Yeah.
Now, the upside of that, I guess, is that if you spend the time and you don't think you got your money's worth, I'll give you your money back, full money back guarantee. Back to your question. Uh, Thousands of people have attended our boot camps. And the topic for the next boot camp is always chosen by the attendees at the last boot camp. We send them out a survey and we say, what would you like to spend the next 24 hours in your life learning about deeply? This time it was gold.
Interesting.
So our audience chose gold. Now, sometimes our audience have chosen topics that I didn't think that I could do a sufficient job on. And so we've defaulted to the second choice. In this particular case, they chose a topic that they wanted that I'm knowledgeable in
Mm-hmm.
and that I could attract a knowledgeable faculty to.
Yeah.
So it has to be a subject that's in demand that I think we can do justice to.
Yeah.
Uh, I've been talking to the gold audience, Carrie, for almost 50 years. I talk to that audience well because I'm part of it.
Yep.
Empathy is always more sincere than sympathy. And by now, after 50 years, I've been involved in virtually all aspects of it. Uh, Dealing bullion, buying bullion, financing bullion, investing in mining stocks, speculating in mining stocks, being a broker, being an investment banker, being a merchant. I've done all of those things
Mm.
around gold. And uh, as a consequence of doing it for 50 years, I've become acquainted with people who not only are expert but are also good teachers.
Yeah.
People that not only know the story, but they can tell the story. And it's a story for reasons that we'll get into today that need to be told.
Mm.
When I think about investors as a class, investors that I've talked to over 50 years, it's very difficult for me to think of a subset of investors that should not be invested in gold.
Yeah, I would agree with
It's,
that.
I mean, with the possible exception of estates, dead people, there's no forward-looking constituency that I can think of that shouldn't be invested in gold. And yet, as we'll discuss later today, gold all over the world, but especially in the US, is underowned.
Do you think, and we will get into lots more things, but as I sit talking to you now, there's a lot of focus, a lot of attention going on Bitcoin at the moment. It's gone over 100,000 US per Bitcoin. It feels like a lot of liquidity going into Bitcoin. I know that in this boot camp, I'm not sure whether you're going to be covering it, but I think you're probably going to say why Bitcoin is not digital gold. But what I'd love today is, do you think that potentially Bitcoin's taking a bit of the shine off gold? Excuse the pun.
If you use the word bit, yes. The market capitalization of precious metals and precious metals related assets relative to all asset classes in the world is infinitesimal. And Bitcoin is a quarter of infinitesimal.
Oh,
Meaning that if you look at the market share of Bitcoin and gold combined, they're an irrelevance. They compete with each other in terms of the lunatic fringe, a little bit, the speculative fringe.
okay.
And so I guess in the context of some penny stocks that can't get funded anymore,
Yeah.
this intermediation from penny stocks to Bitcoin matters. But the truth is that they have very different roles. And I think both of them have legitimate roles
Okay.
to play in the world, but I don't see them as competitors. Now, I say that knowing a lot about gold and not knowing very much at all about Bitcoin. We will, at our boot camp, talk a lot about gold's place on the blockchain
Oh,
and
interesting. Okay.
digital gold coming up and the not so distant future where there is physical 100% backed gold at depositories, where there is a digital depository receipt that can be redeemed for physical gold and can be tokenized. So you will see gold on the blockchain. And you won't see it on the blockchain merely in kilo denominations. You will see a gold denominated token that you can buy coffee with at Starbucks.
Right.
That'll come, and we'll talk about that. So that is a subject of discussion. We're not going to spend a lot of time in Bitcoin in our boot camp, just because we think that Bitcoin is at best distal to the conversation about gold. This conference is going to be about gold.
All right. Well, speaking of which, I speak to people, and I guess most people understand currency. They don't understand the debasement of their currency. They do understand inflation because they're always talking about how expensive things are getting. They do talk about gold is just too difficult to understand. So therefore, they trust the government-backed currency, which is being devalued massively, and they don't understand the correlation between inflation eating away their paper and where gold sits. I know that's quite a lot that I've encompassed there, but I do think it's important that we speak about this today, Rick, because I want people to understand why the CPI, or should I say the CPI, which is where they say, oh, inflation's only 2 to 3%, is quite frankly incorrect. And I would love your comments around that and your comments around why you think, generally speaking, there's only 0.5% of people that even understand or invest in gold.
So let's unpack that. Frankly, you gave a great statement. I'm going to give it back to you and pretend I said it, not you. Uh, let's start with the last one.
Yep.
Gold historically has done well when investors are concerned about the maintenance of the purchasing power of their savings in fiat dollar denominated instruments, which is to say Australian savings instruments or American savings instruments. So let's determine arithmetically, at least in the American context, whether those fears are realistic. Most people's interpretation of inflation centers around what you and I would both describe as the CPI, the Consumer Price Index.
Yeah.
I'm going to suggest to you, Carrie, that while the CPI measures a curated list of prices, that it doesn't even attempt to represent a measure of the deterioration of the purchasing power of the US dollar. To begin with, core inflation, core CPI, doesn't include food or fuel. Any index which doesn't include lunch is of no use to me whatsoever. Then, the index is, quote, hedonistically adjusted, which is to say, they don't add in the price of my computer. They add in the price of the utility that I think I enjoy for my computer. If they believe that apartments are of a higher quality than they used to be, they adjust the price of rent hedonistically to arbitrarily charge or credit me from the quality that they impute in the goods that I buy. That's very much like the judge comprising the jury in a criminal trial. Also, the CPI doesn't include tax. Now, a cost of living that doesn't include the single most important component of my household budget is of very little use to me. I will admit, Carrie, that if I didn't have to pay the tax, I wouldn't bitch quite so much about the index. But that's not on offer. When I look unscientifically at the basket of goods and services that I consume that represent my cost of living relative to my savings, what I learn is that the deterioration of the purchasing power of the US dollar against my lifestyle, and by the way, I'm an old cheapskate, I don't spend much.
I'm the same.
What I learn is that the purchasing power of my dollars is declining at about 7.5% compounded. The CPI tells me 2.6, and my check register tells me 7.5.
Wow. Yeah.
Ask your viewers, or I'll ask them right now. Carrie's viewers, I'm asking you. When you look back to 2020 until today, what has happened to the price of gasoline? How about groceries?
Groceries.
Has the price of a new mortgage gone up in the last 4 years? How about your taxes? Have they risen? Does 2.6 seem like the right number? Or is it some higher number? When I look at the price I pay for goods and services relative to what the indications are from the CPI, I see no connection whatsoever. And this is where you get to gold, Carrie. Gold is done well when people are concerned about the juxtaposition, the relationship between the deterioration of their purchasing power and the value of their savings. So let's do the math again. The purchasing power of my US dollars is declining by 7.5% compounded. But if I buy a US 10-year treasury, the world's preeminent savings instrument, the one that all the others are priced off of, sorry, Australian consumers, it's just a fact, that instrument pays me 4.2.
Oh,
so I'm
really?
Getting 4.2. I'm getting paid 4.2 in a currency that's declining at 7.5. What that means is that my government solemnly swears to me that they're going to reduce my purchasing power by 3% a year every year for 10 years. The first promise, by the way, Carrie, that my government has made that I believe, but it is not particularly attractive from a saver's viewpoint.
Nope.
If you're thinking about whether or not you should be concerned about the maintenance of your purchasing power, when the government guarantees that you can't get it, you should be concerned. And for that reason, historic reasons, I think gold will do well. People say, well, if that's true, when will gold move?
Gold moved
Well,
ages ago, ladies and gentlemen, just
yeah,
quietly.
that's right. It started moving in the year 2000. It's up 8% and change a year against a currency that's declining 7.5% a year. How's that for causal causal conjunction?
But what
I
would,
also
yeah, go,
Go
sorry.
ahead.
Well, one of the things I get from a lot of people, and I always say, don't sell your house and your children, but you do have to have some exposure to gold. And by the way, ladies and gentlemen, not financial advice. I don't know your individual circumstances, but a lot of people, in fact, probably 95% of people say to me, but Kerry, gold is so expensive. Now, my answer to them is against what?
Right.
What I'd ask is, what would Rick Rule's response be to those people that say, but gosh, Rick, it's so expensive now?
I would say, if you don't own some, buy some and hope it goes down in price. Gold is insurance.
Ah,
That's really what physical gold is. It's insurance. Gold does well, generally, when the rest of your portfolio is very stressed. When people say that gold is expensive, what would they say about their house in Australia?
yeah,
Does
good.
that mean that they should sell their house?
Yeah.
But I digress. Uh, the wonderful thing about gold, in my experience, Carrie, is if you think about gold as an insurance policy, a fairly small premium goes a long way. When gold really moves, it really, truly moves. In the decade of the 70s, you won't recall, but somebody my age will recall, that the gold price went from 35 US dollars an ounce to $850 an ounce. In the decade 2000 to 2010, it went from $253 an ounce to $1,700 an ounce. The point of those sevenfold moves or 30-fold moves is that if you regard gold for insurance, you don't have to have 100% of your portfolio in gold. If you have 5% of your portfolio in gold and the gold price rises sevenfold, what you've done is insured yourself against a 35 or 40% loss in other parts of your portfolio,
Mm,
which is precisely why you own gold. That's why you do it. A little bit goes a very long way as
okay.
insurance.
Well, as I speak to you today, Rick, and we talk about gold, and I talked about it can be intimidating because there's different ways of either investing. I say to people, you're not really investing in gold, you're protecting your purchasing power, but
Right.
also the speculation side. Now, down here in Australia, and I'm pretty sure the Canadian stocks have been smashed as well, the small cap resource stocks. And it doesn't matter whether, I know you're a big bull on nickel, but we're focused on gold today.
Yep.
They've been smashed. Do you see that? Because I know you're a contrarian investor. Do you say, back up the truck? This is an exciting time. I'd love your view because it's hard to raise funds. The share prices have been smashed of the majority.
Right. Well, Carrie, first of all, as a consumer, that's great, isn't it? Let's say that you were shopping for a winter coat
Mm-hmm.
and you went to a shopping mall, assuming that you go to those places. You're walking down the mall, and on the left-hand side, there's a sign that says bespoke merchant. All goods overpriced. And over on the right, this is, by the way, called bull market merchants. And over on the right, on this side, there's a store that said, all coats 50% off, all assets marked down, bear market merchants. Where would you buy your coat, Carrie?
Well, you know where I'd buy it from.
Would you prepare and that sparkly jacket you had? Would you have preferred to pay twice as much for that jacket as it was worth, or would you prefer to buy it half off? Now, the second thing is that the higher quality merchandise doesn't seem to be discounted as much or as often. And I would point out to you that there have been some Australian juniors that have deservedly bucked the trend,
Okay.
likely because they deserve to, likely because they have delivered the goods for their shareholders. So I would say, first of all, that the fact that merchandise that I would like to buy is being marked down is attractive to me. Despite the fact that I'm 71 years of age, I'm terminally greedy. And I would like to die more wealthy than I am today. You become more wealthy in securities by buying low and selling high.
Of course.
So, how do you buy low when an asset class is in favor? You don't. You have to have the courage to look at mispriced assets and be willing to buy them without the psychological affirmation that comes from a buoyant market.
Right.
It's interesting, Carrie, that everybody wants to be a contrarian when it's popular. But
It
that's
doesn't make any
that's
sense, ladies and
sort
gentlemen.
of an
Just quietly.
interesting challenge. If we look, Carrie, I think there's some explanation. If we look at the uranium market, last 5 years or so, when the stuff was selling for $30 US and it had to go up, nobody wanted to buy it.
Yeah, it's true. It's
The
very true.
narrative was there, production deficits, blah, 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 blah. The price had to go up. Nobody wanted to buy it. When it went from 30 US bucks to 100 US bucks, everybody wanted to buy it.
Yeah.
What happened was that the price action justified the narrative. Because the price action did justify the narrative was no longer valuable. Yes, uranium was cheap. You should buy it because it was cheap. But afterwards, everybody wanted to buy it when it was no longer cheap. And that will happen to us in the gold print, Gary. We will see a higher gold quote, almost certainly for reasons that we can go into if your people would like.
Yeah, I'd love that.
Eventually, that higher gold quote will be reflected in gold company margins. Ultimately, that will cause the generalist investor to come into the gold space. When there are more buyers than sellers, the price of gold stocks will go up, and all of the people who wouldn't buy the gold stocks because they were too cheap, because there was no interest, will crowd into the gold market after the price has gone up.
Right.
I mean, that happens to amuse me by now. There was a point in time when I was younger when that was frustrating and it seemed inelegant to me. I still try to educate people so that they can participate in markets the way that I believe they should, which is to say, buy goods on sale. But most people won't do it.
Why?
And it ends up I don't know. It ends up being very convenient for me, though. You have to have somebody to sell to when the values are realized. That's sort of my suspicion is that most people don't do enough work on their psychological premise, and they require the validation of higher prices to prove the narrative, which is ironic because the higher prices make the narrative less valuable.
Correct.
I also think that recency bias is important. When people are assessing the validity of an argument, they rely less on history than they do their emotional experience in the immediate past. If they've made a mistake in the last 6 months and got spanked, they remember that spanking a lot more than they remember something that might have happened to them positively or negatively 4 years ago or 5 years ago. That turns out to be a mistake. Recency bias really turns out to be a mistake. We are conditioned, all of us, myself included, to, how would I say this? We like our militaries, we fight the last battle.
Right.
So we were living through a very benign period in the period 1982 to 2022.
Oh,
Declining
wow,
interest
that long.
rates. Yeah, declining interest rates, fantastic demographics, the good part of globalization. I mean, you guys discovered this wonderful customer called China that you didn't know existed before that.
It's very true.
Wonderful time.
Mm.
A lot of that era is over. We built up unserviceable public debts in your country and mine.
Yeah.
Uh, the demographics, which is to say the baby boomers who came of age and began their earning career, their savings career. Now let's just say we're in the backside of that curve.
And
Uh,
we're living a little bit too long.
so times have changed,
Mm.
but people are still employing the lessons they learned in the last 40 years without understanding, perhaps as thoroughly as they might, that the circumstances have changed. And if the circumstances change, the conclusions that you draw from your lessons have to change too. I've seen this happen before. When I was a very young man, in fact, before I was adult, partly, in the United States, we came off a very benign good time that began with the end of World War II
Hmm.
and the peace, the peace dividend,
Yep.
and the beginning of American, if you were American, hegemony, which really lasted for a very long time. But there were beginning to be cracks in the facade in 1967. We couldn't raise taxes. We were running large deficits. We fought the war in Vietnam, which we lost, and the war on poverty, which we also lost. And we were left with the legacy of paying for those. So there was incipient inflation, an awareness of incipient inflation beginning in 1967. But American taxpayers didn't regard it as anything other than an intellectual curiosity
Hmm.
until it experienced it for 5 years,
Right.
until the price of gasoline had grown threefold, until the price of groceries had gone up by 50%. It was only after 5 years of experiencing the compound effect of inflation that the awareness of inflation became urgent enough that people took action. When that happened, the gold price went up 30-fold.
Wow.
Now,
Interesting.
I think there's a complete correlation with the fact that because in the United States we couldn't raise taxes and we couldn't reduce spending, that the way we dealt with that paradox was that we inflated away the net present value of our obligations.
Hmm.
We honored the nominal value, the nominal part of our obligations, which is to say, in 1970, if we had promised an American wage earner that he or her would earn $500 a month in Social Security, we did it. It's just that by the end of the decade, that $500 bought $100 worth of goods and services.
Yeah.
According to the US government, always a suspect source, I'll grant you that. The purchasing power of the US dollar in the period 1970 to 1980 declined by 75%.
Yep.
I think that's precisely the way that we are going to deal with the imbalances in American politics for the next 10 years.
Well, I'm going to interrupt you on that one and say I'm speaking to you at the end of 2024. We've got a president incoming who swears he's going to potentially raise taxes, but he's certainly talking about reducing spending. I would love the Rick Rule take on what's going to happen post the inauguration in January, what might change, and will it be dramatic, or is he just a puppet and nothing's going to change?
So he's put the guy in charge of this process who has become a billionaire by accepting subsidies.
Oh, you're talking about Elon.
Yeah. I mean, this is the greatest con in human history, or one of the greatest cons in human history. Your listeners, especially your American listeners, who believe I'm too harsh on the president, should read a book called The Triumph of Politics by David Stockman.
The triumph
David Stockman to refresh people's memories, was the director of the Office of Management and Budget under Reagan, which was the organization that was supposed to reduce the size of the US government.
Mhm.
Remember that Reagan had an actual mandate. He was a very popular candidate who crushed his opposition. Trump won by a whisper in terms of the popular vote.
Okay.
And in The Triumph of Politics, David Stockman, the man who was in charge of the process, talked about how politics derailed the Reagan Revolution in 120 days. Reagan did not reduce the size of the US government. He reduced taxes, which means he reduced the deficit. That's a different way of saying he postponed
The inevitable.
government. He consigned it to his children and grandchildren.
Mm.
And that's exactly what's going to happen under Trump. I would love, love, love to be wrong. But if you look at his campaign, he was promising benefits for this group and benefits to that group and benefits to some other group. In the real world, you have to pay for all those. So what might he use for money?